Starting broadcast. Why isn't this working? It's thinking. I click start broadcast and it's...
It happens.
Come on. All right. Hold on. I'm going to refresh this page. It looks like this broadcast started already. So what's up, Facebook Live? We're here again with HMB Live. Chris, how's my mic? Can you hear me okay?
Yeah, I can hear you fine.
All right, cool. I can hear you fine. Good to go as well. Sorry about that. Every time we get these things going, we get some tech issues, but I guess that's all part of new technology. If this is the first time watching one of our broadcasts, it's called HMB Live. It is through Facebook Live. So if you are on Facebook, check it out. We do this every Tuesday, 11 a.m. And if you have any questions, you can chime in. All you got to do is comment below on this, and we'll answer the question. We'll answer the question for you. So put that right on the screen right here. Comment below and answer any questions you have. If you do want to be on the show live, I also put a link below here. Click on the link, and you'll come into our lobby section, and we'll call you. We'll put you into the show side by side next to us, and we'll do our thing. But we have a lot of fun. Again, every Tuesday at 11 a.m. we do this show. Anything related to real estate, business, finance, marketing, happy to answer any questions that you may have. And as well, we try to stay on we try to put a topic in mind as well. Today we're talking about valuing real estate. Valuing real estate is actually extremely challenging. And I feel like, and Chris can chime in here as well, like I feel like we know so many investors and they're like, yeah, this is what the ARV is. And I get it. But the ARV is, which is the after repair value, or even the as is value of a property, really, really differs depending on who you are, what you are, the comps, things like that. And we're gonna dive into this in a second, but I think this is a really popular topic. So it doesn't matter if you're new to real estate or if you're experienced in real estate. You know, we talk to a lot of investors and every day, and they have a hard time properly valuing properties. And the answer is not, oh, well, my real estate agent told me this is this is the ARV, so that's what I'm gonna go on. That is the absolute wrong answer. A high level position for any real estate investor needs to be understanding the value of the property, understanding how to comp properties, understanding who to reach out to help you with this process. So again, I'm glad you made it here. 11 a.m. every Tuesday we do this show, and we're going to jump in.
Yeah, I think it really can't be stressed enough how important this part is. And like Jason said, you can't just outsource it to somebody and get one quick opinion, because you're basing your entire investment. You know, there's risk, there's money on the line, there's everything else going on. You need to know this number. And if anything, be real pessimistic about it. If you can chop 10% off of what you think it might possibly sell for and your numbers still work, that's a good way to go into a deal. The wrong way to go into a deal is to say, okay, if I get this top comp, then my numbers work. I have to get that. There's just too much risk. There's too much possibility to, break even possibly lose. If you are not super experienced and basing your numbers on the top comp in the neighborhood, Jason's going to expand on that a little bit more here in a second, but that's the number one mistake that we see every day as a lender.
Yeah, absolutely. There's an emotional side of things. You say, well, I need it to work based off this number. My numbers don't work on the front end. Well, that's not really the best way to do that. It's, oh, well, I think it's worth 200, but if I sell for 210, then I can make this deal work. And again, we're gonna expand on this in a second of how to properly value real estate, but it's something that's the most important. And I'll tell you that where we see deals go bad inside our operation, it's when somebody over comps the property and they think it's going to sell more than it does, and on big construction projects where they can't execute properly on construction projects. So this is obviously a huge topic. So let's just jump in. So the first thing is understanding your game plan. Your game plan, my game plan, Chris's game plan could be very, very different. Are you holding this as a rental, or are you flipping this? Obviously, that's the first two things, right? What's your exit strategy on this thing? But more importantly is how well you can execute on this property, right? How well can you execute on this property? If you are a first-time investor, do not compare your finished product to an experienced real estate investor who's done tons and tons and tons and tons of deals. It doesn't work. They know exactly what to put in there, down to appliances, switches, everything. They know light fixtures. They know exactly what to put in that property. You don't. You will, right? Eventually you will, because you'll learn from experience. But you can't compare to a top real estate investor unless you are a top real estate investor. And again, more importantly, how well do you execute on the project? Even when we do stuff, and we've done a lot of projects, and we're not great at at flipping stuff. It's just not something that, even though we've done a lot of them, we still have a lot to learn related to that. And when we go into stuff, if I see big builders or big real estate investors or guys in neighborhoods that I know those properties are worth 220 to 225, we really try to base our numbers off of 200 or 210, because I know that our product's not going to sell for a premium like some other people's. And it takes a lot of discipline to do that, but it's important to understand.
Yeah, for sure. I'd also jump in on another very, very common error in strategy, since you were mentioning exit strategies. And obviously that is very, very important to get that in line when you go to buy a deal, not later on. And also, we hear a lot that the game plan will be I'm going to fix it up and I'm going to try to get a refinance so I can hold it as a rental. And if that doesn't work, then I'll just sell it. And doing that is setting yourself up for some problems, because first and foremost, you're going to, in most neighborhoods, you're going to do different level of renovation work to properties that you're going to sell retail to a homeowner versus rental grade renovations that you're going to lease out and keep as a rental. So if you plan to go in and I'm going to refinance it, and you do rental grade type of renovations, refinance may or may not work out, happens all the time. Banks turn down, other lenders turn down stuff. And you have a rental grade property that you're going to now try to sell to a homeowner. Oftentimes you're not going to have the level of renovations, the quality of property that's going to get the comp that you want, right? And we see that a lot too. And that's really just a strategy kind of error. Yeah.
So we're going to have 4 bullet points related to this that we're going to, I think most people say, hey, dummy, pull comp. Or just ask your real estate thought. And let's be honest, this is a high level task. Understanding values of the properties based on how your value should be done by the main real estate investor in charge. You can't just throw an employee or a real estate agent inside and say, hey, what's this property worth? Doesn't work like that. I want to start. You do not have to reinvent. You don't have to reinvent anything. Do not be emotional on this. If a big XYZ, big real estate investor has a certain color paint, copy it. If they use a certain granite countertop, cabinet, appliances, fixtures, front door color, copy it. It's clearly working for them, right? Copy it. Okay, so after you understand kind of your game plan and mentally determine how well you can execute, then we can jump into the comparables. And comparables are important, but they're not everything. Obviously, I am a strong believer that any real estate investor needs to have access to MLS. They need to be on MLS, on tax records all the time, so they understand these areas. They're hawking this stuff. Now, keep in mind, keep in mind with MLS stuff, they overlap with tax records and real estate agent and real estate brokerage data. So the data is good, but sometimes there's stuff missing there that you need to kind of look into. So like when I pull comps, I obviously I look at all the summaries that the real estate agents write about it. I try to get as much data as I can from that. But also, I like to pull tax records and not just MLS past listings, because sometimes there's properties that sell that never hit MLS because they never use a real estate agent. Now, obviously, some counties and some cities and some states record in their public records quicker than others. So you may not see stuff within the last few weeks or even months, but jump on tax records as well. In Maryland, you go to Maryland Estat. But more importantly, like, you need access to MLS. There's no real reason to run there's no way to really run your business on a high level after that. If you're doing a deal here and a deal there and your real estate agent's helping you with that, and you say, well, I need access to MLS, the real estate agent's the one that uses it, at the very minimal, go post up in their office and have them log in with you and just spend hours figuring out all the data, right? Like, think about this. If you think you're going to sell a property for $210,000 and you sell it for $200,000, that is a $10,000 difference, right? And that's not even a big difference in this industry, but it's $10,000. $10,000 is so much money. So think about that. You need to make sure you are honed in completely on those comparables. They're so darn important.
Yeah, and that's very related to a question that I saw a question pop up. I believe the guy's name is Anwar. He was asking who we use to value properties in Michigan. And that's very related to what Jason was just saying. We don't buy properties in Michigan because that's not our market. We only buy where we are. And we definitely recommend the same for you as well. Unless you're a super, super experienced buyer and you truly know what you're doing and want to expand to other areas, there's plenty to do in your hometown. Yeah,
I agree. And to answer your other question that you had, I appreciate it. Do we fund commercial properties? We do in Maryland, Virginia, D.C., PA, and New Jersey. Commercial properties related to offices, small apartments, some retail and things like that. Nothing too funky, no land development, no gigantic, above several $1 million commercial spots. But little stuff here and there we do. And that's probably about 10% of our current portfolio. So thanks for the question. Again, we do this H&B Live at 11 a.m. every Tuesday. Every Tuesday, 11 a.m. We've been going strong for a few weeks. We use a software called Be Live, which it integrates really nicely with Facebook Live. If you ever have any questions related to marketing for your business, this is a good place to ask it. Happy to share some of the things that we do. Most of the topics we talk about related to real estate, business, finance, and marketing. It's stuff we're very passionate about and happy to share our experiences with you. Just ask the question. All you have to do is comment on this post, and happy to answer any questions that you have. Again, any feedback that you have, sharing, share this feed, comment below if you want to be on the show. Here's a link as well. So today's topic is properly valuing real estate. You don't have to ask a question related to that, but we do like to try to bring some value by having good appropriate topics to what we do every day. So we're talking about how to properly value real estate. We talked about understanding your game plan, understanding how well you execute and things like that. Then we talked about comparables a little bit. Next, let's talk about leveraging relationships for help, right? You don't know everything. I don't know everything. Chris doesn't know everything. Investors that have done tons of deals, they don't know everything. There's always going to be an instance where you need to leverage somebody for help, and that's fine. Here are people you can leverage. Real estate agents that you may or may not know. Several real estate agents, not just one, several of them that know those areas. Maybe appraisers, if you know appraisers in that neighborhood. Other investors that have flipped houses in that neighborhood, maybe neighbors that currently live in that area. Just whoever will pick up your call or return your email, ask them for help. Obviously, some properties are very, very easy to determine what you think they'll eventually sell for, assuming you execute properly. But a lot of properties are unique and they're hard. So there's no shame. I mean, we have a circle of investors that we always ask for help of, hey, this borrower wants us to lend them this. What's your thoughts on the value? Or, hey, we're thinking about buying this rental property. We're thinking about buying this flip. What do you think based on how we perform? you think the value is going to be. So ask as many people as you can. It's think about it. You buy a $200,000 house, that's a big asset to invest in. And there's so many darn variables. So there's no problem in asking people that for help.
Yeah, and a good way to meet the right people is to get involved in your local real estate community. There's typically a bunch of good free events that happen every month. We hold one if you're anywhere around Columbia, Maryland. And there are really, really valuable people there who know the areas that you're buying in because they buy a ton of stuff there. They know what they go for. You can leverage these relationships. Wholesalers are great. People who own rentals, agents who are very active in those areas. So I would recommend being involved in the events in your market. And I think you can pick up a lot of good connections there.
Yeah. So I'm going to throw a question that Aaron Foster just wrote. He commented, I appreciate it, Aaron. In my recent experience, the more unique a property, the harder it is to comp. The harder it is to get a bank or a hard money lender to get a loan. He does throw some extreme cases out there, lighthouses, castles, 2 houses on 1 lot. In his opinion, to consider paying for an appraisal for the front half just to be on behalf for a contingency. And for the most part, I agree. I mean, these harder properties, these unique properties, potentially there's more opportunity in them, but there's more money that you could potentially make in them because less people want to mess with them. But at the same risk, they could be, or at the same time, they could be riskier. So again, throw your due diligence period out for a longer period of time if you have the ability to, and make sure you fully can wrap your head around what this property is going to sell for or what this property is going to be worth. In this case, on Aaron's deal, he's trying to get a bank to finance this thing. He wants hard money bankers to fund it on the front end, which we're happy to. But more importantly, he's trying to get a bank to finance it on the back end because he's doing it's going to be a rental property and he needs long-term debt cheaper than a hard money lender can give him. He wants cheaper debt on it. So he wants to make sure if he puts in a lot of his own money into the deal on the front end, he's going to be able to get some of that back from the bank for long-term debt. And it's somewhat of a unique property. So again, unique properties can make you a lot of money, but they can also really turn into a liability quick if you have a hard time kind of undoing it. So this kind of wrapped into the few things we talked about is understanding the game plan that, for Aaron, understanding his game plan of what he's trying to do, knowing how well he can execute on it, looking at some of the comps to see if he can determine what he thinks it's worth. And then also he's leveraged relationships of people that he's know. I've talked about this deal. He's talked to other investors. He's talked to some mortgage lenders to see, what LTV they would give him on this property. So it's good stuff. Thanks for sharing, Aaron. Okay, so the next thing, this is our 4th bullet point related to comping properties and valuing properties. And I wasn't 100% sure what to call this, but I just said hone in on the landscape of the property, and that doesn't mean like the actual landscape of the property, but just the whole side. So let me go through a few things that people miss all the time, and it drives me nuts that they don't take this stuff in consideration. So let's say you have a property and you comped it and the comps show that it's whatever, 225 value. There's a few things that sometimes you don't take in consideration. A lot of times, most people, they think about how many beds, how many baths, and square footage, and that's it. But what about if it's on a double yellow line, meaning that it's outside of a neighborhood and it's on a highway? What happens if there is telephone lines in your backyard? What happens if it's a row house or a semi-detached house and the house next to you is either boarded up or it's really ugly and outdated or long grass, or even worse, it has a barking dog that's outside all day long and you can't even show it to a buyer because they're scared that this dog's going to jump over the fence and bite them. Oh, and by the way, these are true stories of situations we've been involved in before.
Oh, yeah.
So from experience, this is how we've learned this, and this is how we've been sharing some of this. What happens if it's a corner lot and it's on an intersection and all of a sudden your house is like right here and the cars come in to turn left and it's 9 o'clock at night, you try to put your kids to sleep and then the lights shine right into the window because they're turning in a corner lot, right? What about the elevation of the property? Let's say you have to park on the street and you have to take 2 flights of stairs all the way up because it's parked. You're not going to have water issues up there, but you're going to have issues moving into the house, kids climbing up steps, things like that, school systems. There's so many different variables on this. I think we did a video on this a while back. I could probably share it if I find it on here. But Just little things that no one realizes. Everyone pulls comps and everyone reaches out to their real estate agents to see what they want to sell it for. Now, I'm very pro real estate agents to sell all of our houses, and they do sell all of our houses. But a real estate agent makes money when they sell the house. If they sell it for you to make a profit, or if they sell it for you to take a loss, they're still making money on that. Now, don't get me wrong; they're a good person to utilize, but you need to hit up your resources and you need to fully understand your surroundings before you can determine what you're going to sell this property for.
Yeah, and I would also throw in there, related to appraisals, of course, real estate investors aren't using appraisals all that much, but there are instances where they can be useful. And knowing an appraiser, one thing that they do know and they have been trained on is the price adjustments for the stuff that Jason was talking about, for the double yellow line, for the elevation for this, for a pool. Pool's another one that is a curveball for people. You might think it raises value, but it can actually lower it. And the standard price adjustments that appraisers know and that are trained on can be very helpful. And it might be overlooked by an investor who doesn't have that kind of training.
Yeah, all good stuff. So again, comment below if you have any questions. Happy to talk. It doesn't necessarily have to be in this topic. It can be in any topic of business, real estate, finance, or marketing. We are talking about properly valuing properties today. And Ian Horowitz has a really good comment that we want to talk about: how to properly value a rental property. So again, the properties we were just talking about is just values in general, maybe more leaning towards flip properties. And Ian wants us to expand a little bit on how to properly value rental properties. Do you use ARV or cash flow? And I think that's the way to answer that is we like to use both, and I think you should use both too. Now, I'll kind of back up a little bit just so everyone understands fully what his question is. So ARV is after repair value, is what's the property be worth after it's completely fixed up, and a cash flow analysis is based on the rent rates. How does it value that way? Maybe use cap rates and things like that. Now, it's more of a banking term. That's how banks like to value properties. I don't really like valuing properties because, for instance, let's say I have a property that I can sell for $100,000. There's a chance that if you use an income approach or a cash flow approach based on that area, it could be worth $120,000, and maybe you get a loan based off $120,000 based on how good your cash flows are and things like that. But to me, something's only worth what somebody's willing to buy it for, to pay for it, to trade, for me to sell to them. That's how I use the term worth. So I still base it off of 100 in that particular case. So when we look at stuff, we look at two things. Number one, we do look at the cash flow because the cash flow is super important. Obviously, if the cash flow can't cover the debt service, and in each rental property you kind of have to look at as its own individual business. The money that comes in minus vacancy rates, expenses, and things like that, does it cover your costs to operate the individual property? So that's super important. And if it doesn't, then it doesn't work. But at the same time, I also like to base everything off the value of the property. Now, for instance, in order to do a flip property, you need to buy a property closer to 65. You need to have about 35% built-in equity, gross equity. A rental property, maybe not that much. But keep in mind, you never know when you may need to unload something. So I like to have around 20% equity in rentals. If we could have 35 or 40% equity in rentals, that'd be great, but that's just not realistic a lot of times. But the last thing I want to do is be into a property for $100,000 that's worth $100,000, even if it cash flows so much, because you never know when you may have to exit that asset. And I want to make sure I can exit it if I need to. So having 20% equity gives us a little bit of room that if we had to sell, we could sell, and it has some built-in equity. So it's always nice to have.
Yeah, for sure. And the short answer to Ian's question is really that you have to look at both of them. You have to both look at ARV and cash flow for all the reasons Jason just said. And also, I'll just add in there too that take into consideration that the bank is definitely going to look at both. And if you're holding as a rental property, you do need bank money unless you're just a cash buyer and are buying it in that way. In all likelihood, you're going to need bank financing at some point. So yeah, be very, very tight on your cash flow numbers in terms of the principal, interest, taxes, insurance, maintenance costs, potential vacancy, and how much you're going to be getting from the bank, and make sure that your numbers work in that way. And then also the potential sale, like you got to dump this property for whatever reason, and make sure the ARV is there too.
Yeah, cool. Hopefully that answered your question. So if anyone else has any other questions, make sure to comment below. Happy to answer any questions. We have a few minutes left, so if you have any other questions, throw those in now. If not, it's going to have to wait till next Tuesday to get answered. Again, we do this HMB Live, Facebook Live show every Tuesday at 11 a.m. Every Tuesday at 11 a.m., we do it live. If you want to be on the show, we send out links and we comment. We have posts below with the link to get on the show live. We've had a few people that were interested in doing that in the past. Give yourself a little publicity, jump in front of the crowd. We try to have a handful of people that watch this show live when they have the ability to, but we get several hundred people within the week afterwards, just because they don't have the availability to watch it live, but they watch it afterwards. So if you want to come on the show, feel free. Happy to put you on there, and you can comment below as well. But it's 11 a.m. every Tuesday. We talk about real estate. We talk about finance. We talk about marketing. We talk about business, stuff that Chris and I are extremely passionate about and stuff that we talk about all the time. So we enjoy it. If you have any future topics that you would like to hear about or learn a little bit more about, you can comment as well, and we are happy to do that.
Yeah, I was gonna mention that real quick too, that in case people are watching this not when it's live but later on, and you want to ask a question in that way, feel free to do so too. Even if it's after the fact, we'll jump back in, we'll comment, we'll address it next week, whatever it may be. Happy to help out in any way that we can.
Yeah, absolutely. So cool. Well, I guess if we don't have any additional questions in here.
I think there is one that just popped up from Aaron.
Aaron, is there a difference of evaluating properties when considering a commercial or residential loan? So it depends. When you use the term commercial, we use the term commercial loan for our rental portfolio. Let me take this out here, Aaron, so we get a little bit bigger screen. Sorry. So, for instance, we use a commercial line of credit with a local bank, and that is only for residential properties, but it's a commercial loan and they treat it like a commercial product. So again, they look at the equity in the property, they do an appraisal, they base it off of that, and they also do a cash flow analysis. So they base it off your cash flow as well. When you use the term residential loan, that's more of Fannie Mae conforming conventional FHA loans, homeowner stuff. Now you can get a residential loan on an investment property. I think whatever the rule is, 5 or something currently now. So you can do that. And if you do that, typically it does have the cheapest rates. You can get like a 30-year amortized loan. I do believe they have to be in your personal name. Is that right, Chris? Or can you do that in an entity?
Style investment property loan. I'm pretty sure you cannot do those in a business entity. It'll be in a personal.
So it's more of like, so you can do that in personal name. I mean, again, that's a great option, but on scale, you're going to run out on that, and you're going to need more of a portfolio lender or commercial lender to do that. So hopefully that answered your question, Aaron. If it didn't,
I'll jump in with one quick story on that. If you remember this situation, we were doing a bridge loan on a restaurant, pretty good size loan, pretty good size property, and we were talking to a friend of ours, and the moral of the story here is going to be that a lot of commercial stuff is going to be much more cash flow based, simply because it's hard to get comparable properties. They're all so different. It's not like a subdivision. I mean, you have retail, an apartment, an office. So we were talking to a friend of ours who's a big buyer and lender in the commercial world, does big stuff. And when valuing the property we did a bridge loan on, he simply talked to some commercial brokers in the area and said, hey, if I had to tear down this property, foreclose on the property, tear it down, build up X, sort of retail thing, how much would it rent for? And then however much it rented for, he based his valuation on that. And it was interesting because he didn't even consider the possibility of a comparable property. It's hard to come by with that sort of deal, with that sort of unique property. And it wasn't terribly unique, and it's not like in a crazy area, anything like that, but it was just like tear down, build up, how much does it rent for? That was his valuation, it was interesting to me.
Yeah, highest and best use. In most commercial properties, that's a good way to look at it, is what's your highest and best use in this. So again, most of the commercial stuff we do are smaller scale, like Chris said, an office building, a small restaurant, and things like that. But it's good to know both. But if you own a lot of residential real estate, I'd consider jumping into a commercial style loan. Okay, so we got a question from Glenn. Not 100% sure. Can you talk more about the percentage of money returns on a monthly versus total nut for that property?
Yeah, I think I know what he's going for there. So it's good to have a model when you go into buying buying rental properties, and an easy one that we've used in the past when acquiring rentals over the past like 5 years or so is that for every $100,000 invested into the property, I think that's what he meant by total nut for that property, invested into it for acquisition and construction, for every 100,000, we want $1,500 in rent. That was our formula. That's what we went out to acquire properties using those metrics. And, it works different in different areas. Like, certain higher end areas, you're not going to get 1.5% per that 100,000 on a monthly basis. And in lower end areas, you can get considerably more, but then there's not going to be the resale value and everything else. It's straight cash flow play. So whatever it is, I would just say know your numbers and know your game plan, and then go out and find the product.
Yeah, fair enough. Fair enough. Yeah, I mean, we could, we're not talking too much about rentals today. We could kind of in the future, but, in that case, what you were just saying, A, B, and C properties, A properties have a good chance of appreciating, but you're not going to get them at a super low discount with a ton of equity built in, and they may not cash flow great, but they could be a really, really good play. Long-term C are probably crap hole properties that cash flow great, but will never appreciate. And you get a much better return on those. And we try to live in like the B world, B minus world. That seems to what fits our models. It has fit our model so far. So it's all good stuff. So again, I want to thank everybody for sharing some time with us. We do this show every Tuesday at 11 a.m. Every Tuesday at 11 a.m. You can comment on the feed and get your questions answered. And we also do links related to being a show guest. And if you click on the link, we'll have a new one coming up for next week's. But if you click on the link, you can come on the show as well. And again, we certainly appreciate you guys spending some time with us. If you have any questions, feel free to comment below. Any topics, comment below. And we'll get the new HMB Live, Facebook Live link coming on soon, so we can see you next week at 11 a.m. every Tuesday. Hope you guys can make it.
See you guys next time. Thank you.
Take care.